What's up? It's episode 86, Payne Points of Wealth, and the sky is literally falling. We're in an official bear market now in the S&P 500. NASDAQ down over 30%. The headlines get more dire by the day. War continues in Eastern Europe. And Bitcoin, we warned you about Bitcoin, is melting down. Well, we're going to break it all down for you today. We have a special guest on the show today. We have Lee Robinson. He's the co-founder and CIO of Altana Wealth. He's an asset management firm, basically running all different hedge fund strategies. He actually, back in the day, predicted the credit crisis between 2007 and 2009. He's seen a lot of bull and bubble bursts, and he wrote a great book called The Gathering Storm, and is a BA in mathematics from Cambridge University, and a good friend of mine. Lee, great to have you on the show today.
Pleasure to be here.
Man, oh man, what interesting times to have you on this show.
Absolutely.
The world's falling apart, and you've seen a lot of this in in basically your experience. What do you make of the current economic environment and market environment?
That's a broad question. I think I think we've gone through possibly the craziest fiscal monetary expansion experiment in the history of mankind. I think we've never seen this on a global basis, where every country, a resurgent China, a dominant, America, a European Union of 27 countries, UK, Australia. We've never seen everybody come together and just print money like they did after 08, 09, and then after the European crisis, and then the pandemic, and cutting rates to zero or negative rates. What an incredibly stupid idea that is, right? And we've never seen that happen. And of course, guess what happened? Like all governments, they all do things thinking there'll be no reaction. They just think that's it. We've done it. We painted the line. No one will cross it. And guess what? People bought all sorts of stuff, and be that crypto, be that leveraged notes, whether that be Italian bonds at 0.25% yields. And suddenly, guess what? The world changes again, and the liquidity drops from the greatest level in history, and everyone can see there's a bubble in everything. Well, there's going to be some pain, right? And I think everyone knew that was coming, and maybe was in denial that it would happen in their lifetime, but it's now beginning, right? They've now lifted interest rates. They're cutting QE to going to QT, and there are consequences, as there were on the way up. There are consequences on the way down.
So Lee, with crypto, for example, as that starts to unravel a little bit, it looks like there was a lot of speculation and leverage being used. Do you see that as any type of systemic risk to the rest of the world? On top of all the other problems we're looking at right now?
Look, you never know which straw is going to break the camel's back, right? But I mean, just picking up the numbers, $1 trillion has been written off crypto over the last N months, right? But there's been $2 trillion written off the NASDAQ, right? So just to put these in perspective, these are big numbers nonetheless, but they're not the only factor that's going on at the moment. And what's going on at the moment, I think, to some degree, is this week particularly, is a lot of leverage players have been caught up with illiquid assets, and this is not that different from 07, 08, right, where people have promised 20% yields with instant access to your money, and people have gone, oh, that's fantastic. There can't be any catch to that at all, no risk at all. But no, then the people who've actually been doing that have gone out and lent the money at 22, 23, 24%, which in itself was risky, for 6 to 12 months, and they've had their money locked up. So not only were they mismatched on their liabilities like the banks were in 07, 09, they've done exactly the same mistake here, except for in instruments that are not houses, not, to some extent have, let's put it, long-term possibility of getting your money back. In some cases has been mythical, like Luna and Terra, which didn't exist. These are two new currencies that are pieces of paper that didn't exist, I think, 3 years ago, right? Whereas at least, houses in most areas of America, most areas will be, under land upon them, will have some value. It might be 30 cents on the dollar, it might be 40 cents, but it has some value. So no, I don't know if crypto is a systemic risk, but it's another problem. I mean, the nice thing about crypto is that it was so hated by the banking system. There isn't a lot of leverage from a banking point of view, so I don't see it rolling over that way. I'm less worried about that. I'd be more worried about, European banks leveraging up their debt on Italian debt or something like that. But, look, none of these things are good. $1 trillion, I know I'm old-fashioned, but that to me is a lot of money, right? And a lot of money, and it doesn't help. And there's a lot of people who have bought cars and toys and whatever with their Bitcoin profits. I mean, I don't want to show off, but we got in at 435.
You and all the drug dealers and people buying listed things with Bitcoin, you got in at that level.
I like to say that that's true, but you know what? I think that's a myth as well, because if you look at the average cocaine transactions in New York alone a day, it was greater than the value of Bitcoin in 2013.
Why do you know that stat?
I'm a man who knows things. I know things, right? And the truth of the matter is, it is a world where a lot of money was made on the upside, as was NASDAQ stocks. Plenty of people bought the new car on the back of Snap or Zoom or whatever, and suddenly, guess what? That's gone. Now, if they sold their shares and bought that car, that's great. But if they then borrowed against it from the bank and then borrowed against the car company and then the price went down, it's a disaster. And that's what we don't encourage people to do, and I'm sure you don't encourage people to do as a wealth management firm, right?
Well, you know how it works, Lee. It's like there's no institutional memory when it comes to investors. That's why dogs chase cars and investors chase speculative stocks and situations, right?
Yep.
I actually had a client call yesterday who he said, I'm really worried about everything. And he's, I think basically his allocation's almost 65% in fixed income, in AA municipal bonds. And I said, well, you really should make sure you unload any of that cryptocurrency you bought. He goes, oh, no, I totally believe in that. I just don't believe in the U.S. economy anymore. I was like, okay, that's a little broad for a statement. But if people do get a little crazy when the markets get this volatile.
Hey, look, there's never been an empire that hasn't failed in the long run. So he's probably right. It's just a question of how many decades he wants to make that bet for, right? So.
That's a fair point. But I think, what's interesting too is it's like with markets specifically, it is kind of like we always say markets, they don't repeat, but they sure do rhyme. And, going back to like the housing crisis, and I remember like in late 2007 going to dinner and the waitress was telling me how she owned like 5 properties and she was borrowing us those properties to buy more properties. And it was just so indicative of what you've heard in the crypto markets now for the last couple of years that like from our viewpoint was just like, okay, when is this? It's not like if, it's when is this bubble going to burst? And I see that mentality right now where people are like, oh, well, hold on. This is just one of the big sell-offs that you're going to get along the way. If you hold for the next couple of years, it's going to go up again, which says to me there's probably more pain to be had in that trade. Just my guess.
Look, I'm long the stuff and I've been in it and we got a fund that runs it. But, you got to recognize that this was at 4,000/5,000 in March 2020, right? It was 8,000 before COVID. Let's pick 8,000 before COVID. Let's pick a reasonable time frame, and it's currently at 20. So these investors are still up a very, very considerable amount, and you can laugh at them or not, but if they were smart enough to take some money off the table,
they probably weren't.
They probably weren't, but a lot of them are up, and the problem is, and a lot of people. Also fall down the trap is, look, I would never recommend to anybody. I'm a crypto manager, right? I've got part of my business is in crypto, but I recommend to people to have 1% in crypto. I don't go to them and say, put 25 or 30, right? And I think, that's okay. Any investor can put 1 or 2% in the odd stock or the odd thing, as long as the rest of their portfolio is reasonably well structured with some, as you said, Bob, your friend with his 65% municipal bonds, he probably can take a little bit of risk on his crypto. The guy who's got, he's mortgaged up the hill and needs cash flow, maybe he can't. So different people, different things, and as you said, Ryan, different people have different time horizons, and many a person has made an absolute fortune, buying Amazon, and they held it through 2000, 2001, 2, lost a lot of money and stuck with it and averaged down, and hey, what, so, I don't think we should be too judgmental about different people, different tactics, right?
Just like to meet that person that held Amazon all the way through, because I don't know him.
Yeah, I've never met them either, and I've never done it either. But yeah, let me tell you a quick sidebar. Actually, just going back to what you said, Bob, about stories. Would you believe? I don't know how much your audience follows this crypto car crash at the moment, but there's a company called Three Arrows Capital which has effectively blown up and done a runner. Gone from Singapore. Apparently, they've left their yacht in Singapore and they've flown to Dubai, and they owe everybody hundreds of millions. I mean, it's a terrible story. But a true story. I had a call with one of the two guys. I'm going to say 2 to 3 years ago, and he didn't know who it was, but we were just talking about lending and collateral and all the rest of it. And look, I'm 52 and I've been through a few credit cycles, right? And he's been in the business for about 3 minutes, right? And he was lecturing me on credit risk. I mean, that's how arrogant. Didn't ask me, Lee, you're a wise old man, do you have any views on what you might do? He literally lectured me. And then the call, I said to one of my colleagues, I said, it's nice to be lectured by somebody who's never been through a credit cycle, This guy, and you wonder why he blew up, right? And, there's, again, it's not just greed, it's arrogance. And we talked about it, Ryan, a couple of times. Never confuse genius with a bull market.
It kind of goes along that same vein of all these young traders saying that Charlie Munger and the likes of Warren Buffett
I'd rather be lucky than good, Lee.
I'd rather be lucky than good.
Any day of the week.
No, look, to be fair, Charlie wasn't as good as he was 3 years ago. Yeah, I mean, look, he's 96, 5, but he's done something that most people should do, which is be patient. Right, and wait for opportunities, and he's been lucky. Of course, they've had a big pot of insurance money. It's not the same as your average person, and we can't compare ourselves to somebody who runs an insurance fund. But nonetheless, you don't see them rushing in. They think, they wait, and look, they've made tons of mistakes. Don't kid yourself, they haven't. But most of the time, they made the mistakes after thinking about it for a long time. They haven't rushed in. And I would always say to investors, there's always another trade. There's always another Bitcoin trade. There's always another Microsoft Amazon. Don't panic. Don't worry about missing it. There's always another trade. And as long as you're patient and you survive these downturns, you make a lot of money.
In investing, it's always about patience, that's for sure. But I think it's a good point, too, is, I think, you saw Warren Buffett. We talked about Warren Buffett, Charlie Munger in the first quarter, and they did the most buying they've done in probably over a decade. And I think that's the point, right? I mean, it's really about where these companies going to be worth over the next couple of years, right? And I think that's what's hard for investors to grasp, or if you're trying to build wealth for the long term, is anytime you get a sell-off like this, no matter where you buy, it's probably going to be a great opportunity when you look in retrospect. I mean, I remember back when we talked about the financial crisis, Warren Buffett was getting in around 10,000 on the Dow, and the Dow proceeded to go down to like 6,000, but it doesn't really matter, right? The Dow's at 30,000 today. So the point is, I think anywhere in here as a long-term investor, you are getting some great value. So Lee, in your illustrious career and the Street of Dreams, if you get one piece of advice that you could, really impart on the rest of us that you've learned over the years as an investor, what would it be?
Look, I think the biggest mistake that I see in finance is that people cannot work from the forward back to the present. So, they get panicked. They see a company, for example, has a profit warning because it couldn't satisfy an order. Well, those orders are still going to come. Still means it's a good business. And they mark it down 10%. So there's a lot of short-term emotion and not enough rational thought about long-term. And I think if you're investing, I'm not talking about trading for the next. Traders are different people. They can buy high and sell higher, or they can sell low and and it goes lower. But as an investor, just try and think forward. When you're in a pandemic and Carnival is not allowed to do any cruises, does that mean that cruising is over forever and that business is worth zero? Probably not. So I do think sometimes just, investors need to think, I am investing for the long run. What does this business look like in the long run? And then think, well, is it too expensive today? Rather than thinking, I'm buying it today, can it go up tomorrow? And that side of things. So I think investing is something people don't understand. They confuse it with trading.
All right, it's the tipping point. This is where we pinpoint the pain point having the biggest impact on your wealth right now. And Bob and Chris, when it comes to financial planning for the 1,000 or so families that we manage at our firm, Payne Capital Management, is we find that a lot of you have false beliefs when it comes to your wealth. And I thought we could expose some of the more common, I'll call them financial untruths that you might believe that you really need to correct if you're going to, have a financial independence plan that's going to work. And the first one that we get for anyone who's getting close to being financially independent, or we'll call it retirement, is this belief that you only need 80% of what you need when you're working, when you're actually retired. And as we know, guys, that's just not true.
I want to call this show Mythbusters because that's a myth I want to bust. Not only do you spend 100% of what you spend today, in the first few years of retirement, because you're not going to work anymore, you're going traveling, you're spending more time with your kids and your grandkids, you probably spend close to 120%. And I got news for everybody, and Dad, you could probably attest to this. The bank of mom and dad or the bank of grandmom and grandpop never closes.
And that's why it's so critical to have a strategy a discipline where you're updating your financial plan on a systematic basis. I mean, I love our e-money portal because it updates everything in real time. So it's easy for us to do a planning session if someone decides to take a longer vacation or to buy a new home or to gift more money to the grandkids. So, it really does come down to knowing what you own and knowing why you own it, but also looking at the implications of what's on everybody's mind right now, guys, inflation.
Yeah, well, and that's the thing, right? When you're actually running the numbers, you just need so much more money saved today than, let's say, generations before. Because if you're retired or financially independent, that could be 20, 30 years. And then to your point, Bob, you have inflation on top of that. Whatever you need today, that's going to double what you need over 20 years. Or said differently, every $1 million you have today is worth $500,000 every 20 years. And then put on top of that, you probably have some healthcare costs, unexpected. It's crazy, right? It's kind of scary, actually.
Well, here's the other thing too, guys. I mean, I do probably 100 reviews a year, and the one common factor that I find is that none of you have a clue of what you spend. What I find is that take what you spend, what you think you spend, and increase it by 20 to 30%.
Well, the big question I always have is, I know you don't know what you spent, but you made X from this company in salary and Y from that company salary. How much did you save? And then when they're scratching their head and it comes out to be a big zero, then you know exactly what they're spending. And it's okay, right? But you just got to make sure you're going to be able to do that when you're 80 and 90. Maybe 100.
Well, it's like the old IBM model. When you're doing financial planning, it's garbage in, garbage out. You got to put good stuff into the plan to get a good result.
Well, I like the way you run plans, Chris. You stress the living daylights out of them. You try and make it look as bad and dire as possible. And that way you know that even have the worst case scenario, that you're going to be able to get through it.
Well, Dad, I'm an engineer at heart, so I like to break things to see how far you can push it.
Well, that's why I don't let you drive my car, Chris.
Well, the other thing to consider too is, the one thing that you hear a lot about is you need income. You need income when you're financially independent. You need income in retirement, and the annuity industry is probably the biggest culprit of this. Income for life, guaranteed income, and it sounds so great. But the problem is you don't just need income coming in the day that you live off your portfolio, but you have to factor in, again, that income has to go up over time to account for the fact that your expenses are going to go up over time. And if you have an annuity or something like that, it's the same amount coming in every year. Well, every year you're losing money against inflation. It's not an inflation hedge. So you need income that actually grows over time. It's an important component to your portfolio that a lot of you don't have.
Well, what we just found out? Unlike what a lot of these folks on the financial talking hedge shows have been telling us, is that cryptocurrency is not a hedge against inflation, and it's not a store of value. It turns out gold's not a hedge against inflation, right? It's not going up as inflation goes up. So the true inflation hedges out there have always been the same. Publicly traded companies that can increase their earnings and their dividends on an annual basis are the best hedge against inflation. Bonds that come due, it's the only types of bonds you own, because that way if inflation goes higher, rates go higher, you get a higher interest rates. It's that simple. And having some hard assets in your portfolio, commodities, oh my goodness, am I happy we have commodities because they're up big this year. So it really isn't about being right every day. It's about being right over time.
Dad, I got a comment on commodities. Over the last 10 years that I've been in this business, I think I had clients putting hit contracts out on me because if I bought another share of commodities, I think I would have been maybe considered a dead man. But, I think they're thanking us today.
Well, that's what you're seeing right now, right? It's like, all the assets that went up at the same time were interconnected, right? The person who probably owns Bitcoin or all these different cryptocurrencies is probably the same person that owned a lot of these disruptive technologies, who went technology stocks. Right, so when it sells off, it all sells off at the same time, And that's the point of diversification. You don't want everything working at the same time. And to your point, Chris, like, it was horrible having commodities in your portfolio the last decade. I cry every day we had commodities in our portfolio, but all of a sudden the tide changes and you're happy you have these what we call lowly correlated assets in your portfolio. So, don't feel good when everything's going up at the same time, because that means, as we're feeling right now, everything goes down at the same time. It's the old proverbial, you live by the sword, you die by the sword. Diversification defends against that.
And that's exactly right, Ryan. And that's our whole point. It's not about just having different investments and having 15, 16 different accounts, right? Because a lot of you end up with a collection of investments, right? True diversification is having something that doesn't go up when everything else does. And a lot of you, especially do-it-yourselfers, they've been going back over the last, 5 years, investing in what's up the most. I just repositioned a client's 401k for them the other day, and he said, Bob, everything you picked has a terrible track record. And I said, yeah, because it's at a great value right now. The stuff that I picked for you before has a great track record, but it's time to move out of those investments.
Well, here's another great example. I was reviewing a prospective client's portfolios, and they had 20 different accounts with all different fund names. And I went and did the analysis, and I showed him, I said, you guys are not diversified at all. And he said, what are you talking about? I got Columbia Threadneedle, I got JP Morgan, I got Vanguard. I said, yeah, but everything's in the exact same category, 100% in growth.
And that's the other thing. You don't understand how there's a lot of internal costs. I mean, one of our newer clients said the other day, said, wait a minute, how come your ETFs have a lower expense ratio than these other ETFs? And I said, yeah, that's why you hire us, to go through and vet these things and find where the lowest cost provider is, to get you involved in the market, get that diversification you need to keep you invested, but better yet, to overcome inflation and get you to your goals.
Dad, I believe a friend of yours called you the Walmart of the financial world.
This is true. Lowest prices every day.
But high touch service. Don't forget that. And the other issue too is, I think a lot of times you get that mentality of, if it ain't broke, don't fix it. And that's the worst thing you can do, because eventually things are going to change. And when it comes to your strategy and your financial independence plan, it's always about being proactive, not reactive. Like right now is a perfect time. You want to be making adjustments, because I think the biggest fallacy right now is, oh man, I'm down big on my tech stocks. Obviously, I just need to hold them and wait for them to go up again. But the reality of it, that could take years. When the tech bubble burst back in 2000, it took 15 years to break even on your tech stocks again. How long is it going to take this time? So it's like, I've used this analogy a lot, but now that the tide's down, you're sitting on a boat, it has holes, it's sinking. This is when you want to re-diversify your portfolio, because when the markets do recover, and they will, it's going to be a change of leadership. It's not going to be the same winners that you had the last decade. So before that happens, this is when you want to make those proactive moves. Don't just sit with your head in the sand right now and hope for the best. It's not going to work. Bob, Chris, and I now have a collective 75 years helping individuals just like you with your planning and investing. This is literally what we do every single day. Everything you hear on this podcast, along with some due diligence of your own, can help you get ahead financially literally at any stage of your journey. But if you want a more hands-on approach and you've saved over $1 million in your financial independence plan, we'll run for you our total financial master plan. We can do that with no obligation or cost. It's a full holistic review where we look at everything. We'll build a full income plan for you. Factor in inflation. We'll do a full expense and spending plan for you. Figure out what you need to spend when you finally do retire or pack it in for financial independence. We'll go through every investment that you own, show you where the hidden costs are in your portfolio, show you how to optimize your portfolio for taxes, and show you how to diversify properly so that you can defend yourself when these markets go down. We do these every week. Go to www.paynecm.com/financial plan to see if you qualify for a free financial review. That's www.paynecm.com/financial plan to see if you qualify for a complimentary financial review. All right, it's the hidden facts of finance, random financial facts that may surprise you or even shock you. All right, Bob, a group led by Walmart heir Robert Walton agreed to buy the Denver Broncos for $4.65 billion, a record in U.S. pro sports. That's crazy.
I just can't help but wonder what that cost basis was on the company who sold the Denver Broncos. Being a long-suffering Eagles fan, I remember when Leonard Toews lost all his money gambling in the casinos, who had to sell his franchise, the Philadelphia Eagles, for $125 million. I thought that was all the money in the world. Kind of pales in comparison to $4.6 billion. I think he made a big mistake.
Yeah, and it's good to inherit wealth, and you can buy teams like that. So, Bob, You have to work a little harder for us.
I'll try it.
Well, I can tell you one thing: neither Ryan nor I, if we ever inherit any money, will ever buy a sports team.
That's a good point. Chris, Apple generates more revenue than any other American company. This year, the total should be around $400 billion. To boost revenue by 10%, Apple needs to find $40 billion in additional sales. That's about the size of the company's Mac business. The bottom line is growth becomes harder the bigger you become. This could be problematic for a lot of these big mega cap tech stocks.
Well, you know what, Ryan? I'll tell you what. When my first job out of college, I sold copy machines door to door, and the way our sales manager used to motivate us to sell more would put us in a room and yell at us and tell us how much we sucked. So maybe Apple should take that strategy.
That's always a great way to motivate your sales force. So we should implement that at Payne Capital Management. I think our advisors would appreciate that.
What do you mean implement? Isn't it already?
Yeah, by the way, Chris, how's your pipeline look this month? All right, Bob. Worker swipe-ins at office buildings were recently in the 30 to 40% range in major markets such as New York, Chicago, San Francisco, and above 50% in the Sun Belt, markets like Dallas and Houston. People are not back to the office in droves yet.
No, they're not. And I don't know if this is a new model forever, where you spend maybe a day or two in the office and the rest of the time you telecommute or work from your desk in your home. But it seems like a lot of folks want that. But meanwhile, I think you made a good point the other day, right? You got to start going out and seeing people again. I think when it comes to your clients, or in case you're somebody's business, their customers, if you don't go to see them, somebody else will.
That's true. Business is all about those personal relationships. So my prediction is in the next 3 years, we're all back to the office. Telecommuting is a thing of the past, but we'll see how it pans out. Chris, U.S. inflation doesn't really stand out globally anymore. It's 48th highest on the list of 111 countries, whereas last year we were ranked 28th out of 116 countries. Inflation right now is a global phenomenon, not a U.S. phenomenon.
Well, the other thing I would say too is, as U.S. citizens, we pride ourselves in being number one in so many areas. I'm just happy this is one of those things that we're not.
But at 8.6%, it still ain't pretty. All right, gentlemen, another great show. Hey, if you like our podcast, love our podcast, give us some love. We're up to 90,000 downloads. Just give us that 5-star rating on iTunes. Give us a subscription on Spotify. And if this is on YouTube right now, give us a like. You can subscribe and click that notification bell. You can be updated every single week. All our new content. That's it for this week. Stay loose and keep an open mind.